We can have the footage. But yeah, man, appreciate you coming on. Honestly, I appreciate you, even taking me under your wing and showing me all kinds of good deals, and bringing me to properties, and then showing me properties, walking me through T12s, rent rolls, what adds value to properties, what doesn't add value to properties that you can actually charge more for from like a rental standpoint. So you've been a great mentor to me, and I'm super excited to be able to share you with the multifamily group. It meets we typically were meeting here in DC, but now we've had to go online, and but these are diehard people. I mean, it's 9:00 and we're here to talk real estate. So
I love it.
These are my people, right? So let's start off with where were you raised?
I was born here in Houston, grew up here. I was kind of a wild kid, so my parents sent me to New Mexico Military Institute in high school. I did 2 years out there. It was in Roswell, New Mexico. Yes, the same Roswell. That the two things that drive that town is the UFO landing. They have a whole museum, and then New Mexico Military Institute is a big military school.
Got it.
And so I went there. I begged my parents to let me come back senior year. They agreed. I was still a little wild at that point, but I graduated from high school here in Houston, a place called Cypress Creek. And I stumbled my way into college, went to Texas Tech for a year. I hated Lubbock. It was up there, West Texas. It smelled like cow, you know what. All my friends were at UT, which is in Austin. So what does Ben do? Ben quits school, goes and moves down to Austin. Goes to ACC, which is Austin Community College. All my friends are at UT, by the way. And I was having a good time. Let's just put it that way. Then I had a buddy that, this is not a long story. I'll get through my whole entire life story here in about 2 minutes. I had a buddy that went out to Los Angeles, wanted to kind of chase the dream, be in Hollywood. And, I always liked writing. I had already written a few things. And so I was like, yeah, man, I'm really not doing much here in Austin, so I'll go out to LA. And we were going to film school out there. It was a film school called Brooks. And, ended up, going through that process. Did a few things out there, nothing anybody would recognize, right? I was a bartender as well. I mean, I had to pay the bills, but after about 8 or 9 years of stumbling my way through Hollywood and not having as much success as I wanted, I had to kind of get back to reality. So I had an opportunity to come back to Houston to work at an IT company here in Houston. And so I jumped at it and left the West Coast, came back to Houston, and did that for quite some time. I did IT sales. I was actually doing some of that out there too. I was kind of commuting back and forth for about 2 years, and that got old. And so I moved back here permanently. And then in 2013, Laura, who is, my daughter's mother, she was obviously pregnant with Lillian, who's my daughter. And as everybody that's had children knows, you got a little bit of time on your hands. So I started listening to a lot of podcasts. I started reading a lot of books. One of the books that I had read was Robert Kiyosaki's Rich Dad, Poor Dad, which I'm sure everybody's probably read or at least heard of. And if you haven't read it, I suggest that you do read it. It's kind of light on the how to do real estate and real big on the mindset, right? Just, I always equate it to, it was a light bulb moment. It truly was for me. Because you start realizing that you're kind of living in, I guess you were trained to be an employee, right? That is what schooling and college trains you to be. They don't train you to be entrepreneurs. They don't train you to be investors, right? You have to learn that on your own in a lot of ways. And so, I was in love with real estate at that point. So as a lot of people do, I kind of seeked out Robert Kiyosaki. And of course he had a training program that I probably spent way too much money on. In fact, I know I spent way too much money on. And I went through that back in 2013, because I'd spent so much money and Laura was about to leave me because of that. My back was against the wall, and decided to, do some flips. I had a couple rentals as well. I did some wholesaling and I went through the whole gamut of what you could do in single family, and, made my money back from the amount that I invested in Robert Kiyosaki's Rich Dad. So I felt pretty good about that. I paid off my credit card, my Amex, and I made some more money, and I kept doing it. But it was a grind, right? Because at that time I was still working in the IT gig, right? And so, you have to kind of weigh your time too. It's an opportunity cost, right? I was making pretty good money at the IT firm, and wholesaling, sometimes you're only going to make $3,000, right? So is it worth it for me to take off a full day, go clear across Houston, which if anybody knows Houston, it's a huge city, to maybe possibly make 3K. And so I started thinking, well, maybe is a single family really what I want to do? And I'd always liked commercial real estate. Like you always look at those skyscrapers, Houston's got a big kind of downtown facade, and, that's what I really wanted to do. I wanted to do commercial real estate. So I started kind of looking into that. And, I came across multifamily. There's a guy named Del Walmsley. He runs a company called Lifestyles Unlimited, which is kind of a guru group here in Texas. They're pretty big, especially here in Houston. And he has a radio show. And so I heard his radio show. He's like, oh, I got this free, seminar thing. Come on out. And so, of course, I go out because I'm a sucker for all these sales pitch guru guys, apparently. And, he gets you fired up for multifamily. So then I buy the 3-day, kind of boot camp type thing. And the whole thing is just a big, run up to buy the mentoring, right? And at this point, this would have been 2015. And I had already dropped 40K with Kiyosaki, and I was like, he was wanting 15K, and I was just like, man, I got to step back. So I stepped back and I said, you know what, I'm a smart enough guy. I know what I'm lacking, right? And I know what I need out of a partner or partners. And so I was already doing a fair amount of networking already. And so through networking, I found 2 guys, that were able to kind of fill the I guess the gaps or the weaknesses that I had at the time. We partnered up. We created a company called Valorum Investment Partners, VIP, right? We were all clever when it comes to that. Along the way, we were trying to kind of find our own deal. Well, we were stumbling a little bit. It's not as easy as people think it's going to be, right? Especially when you're starting off, Oliver, you know that, right? It's a grind. You got to pound it out, right? Until you get that first deal. And, at the same time, Brad Sumrock, who used to work for Del Walmsley, he used to be their head trainer, was in Houston at one of the local RIAs, because I was still networking in the single family world a lot of ways, because there's investors there too, was there speaking. And he was small time at this point, right? There was like 10 people at the actual event. I actually got to chat with Brad for like 20 or 30 minutes. And he's like, why don't you come join my group? And I was like, well, how much is it? And he was about half the price of where Dell was. And I think at that point, I realized that I needed some additional training and mentoring, right? And it's not for everybody. And I'm going to tell you, I'll get to another side story here in a minute. But for me personally, that investment lights a fire under me, right? I'm probably best with my back against the wall. And so when I feel like I've made an investment in something, I'm not going to walk away from it, right? I'm at least going to make the money back that I invested in the program, right? And so for me, it was a forcing factor. And so I joined Brad's group in 2015, and it was just like a rocket ship. Like it started lighting, like things just started kind of going. I was networking. I was going to every single event. I was passing out business cards. I was sucking up all the training that he had, his training was all right. But what was good about what Brad has put together is the ecosystem, because I met a lot of great people. I still have investors to this day that I've known from Brad's group, and I knew all the vendors, right? So I pretty much felt pretty confident that I could get a deal across the finish line with what he had put together. And I ultimately did. I bought my first deal in Beaumont. It was a 92-unit property. For people that don't know where Beaumont is, because a lot of people don't, it's 90 miles east of Houston. But I was still kind of struggling, right? The guys that I was partnering with, they're good guys. I'm still friends with them to the day, but I was doing 90% of the work, and we were splitting it 3 ways. So I always tell people, be cautious with who you partner with, because it's a marriage in a lot of ways. And, as people know, you got to work on your marriage. There has to be, support and give and take. And, you have to work at it pretty hard. And so a partnership is no different. And so after that, we did 2 deals together. One was in Sunrocks Group. I quit Sunrocks Group in 2016 and was kind of doing my own thing. We bought another deal in the meantime. That kind of got old pretty quick. So, at that point I stepped away and said, hey guys, I'm going to just kind of do my own thing. I was hosting a meetup event just like this one, right? But it was in person here in Houston. I had started in 2015, and I still to this day, me and Ferris still put it on. And I met Ferris. Ferris was doing single family at the time. He was looking to step into the multifamily game, and he's an interesting guy, man. I've never met somebody that's just so driven. And that was what was lacking in my partners, right? And ultimately, Ferris is probably one of the smartest guys I've ever met, too. And so we developed a friendship, and we said, you know what, man? I was kind of candid with him. I was like, look, I'm trying to come off this other partnership. I'm looking for the right fit here because I want to blow this thing up in a good way. And he's all about scaling, and ex software guy. He's tech startups and all this other stuff. So he was on board. So we created Disrupt Equity Partners in 2017, and we've been blowing and going ever since, man. We currently have about 1,500 units under management. We've sold another 300, and our goal for next year is 2,000 units, and I will absolutely hit that goal because I didn't hit it this year because of freaking COVID, but I will hit it this year. 2021.
I love it, man. I feel like a little kid sitting and listening to the teacher give me, telling me a story. I was like, that was awesome.
Thanks, buddy.
That all started from like one question, like, where are you from? So that was
I gave you my whole life story.
That was really impressive. That was really impressive. That's awesome. So, what was your family's belief on investing growing up?
Oh, they thought I was insane when I started doing this, right? But guess who has been the converts? My family. And I feel really proud because I convinced my mom and dad to invest in my first deal, and they pretty much had written it off. They just thought I was just like, okay, just because my son, I'll do it, right? And that to this day has been my most successful deal. I made 365% return in 2.5 years, and so I got invited back to Thanksgiving. Because of that. And, I'm the favorite son now. No, I'm just joking. I'm their only son, so I have to be the favorite. But no, it was not well received because they didn't understand it. And I think that's really the problem with what we do is, what the heck is syndication? You're gonna invest in apartments. Doesn't some Wall Street guy, isn't that like some PE firm or hedge fund? No, they all own all that stuff. You're crazy. You just need to stick to single family. Right, stuff that people understand, right, or what they saw on HGTV, so therefore it's normal. But yeah, like I said, everybody's come around. My sister's work. I don't know if you've ever met my sister. She used to work for us too. So they've all come around, and now they're supportive, which is a good thing.
That's awesome. That's awesome. So you've told us like specifically like what type of real estate you invest in. That's multifamily. What are some of the things that you like about multifamily, and why you specifically chose that asset class?
And I like commercial real estate in general, right? I think I stumbled into multifamily because it was you're providing housing, right? So I guess for me, obviously most of us have probably lived in an apartment, so we kind of understood it, right? Or at least I understood it. So I gravitated to multifamily, but we like other asset classes too, especially new development, and we like industrial. And we think that there's going to be some plays on retail and office in specific submarkets here probably next year, because a lot of things are probably going to go sideways for some people. But multifamily for me, it was scalable. That was really the big thing that I didn't like about single family. Like, and I kind of allude to my earlier statement where I was going across town to one of my single family rentals, or I was going to try to go flip a house on the other side of town. You can't do that. That's not scalable, right? Now, don't get me wrong. I've seen people that are wildly successful with single family, but they got to a point where they could systematize it. They could bring on property management. They could do it like a multifamily property, right? But I like the idea of, instead of buying 100 houses here in Houston that are spread across town, why not buy 100 units right there in the exact same place where you have some economies in scale? And if I'm going to go visit my property, all I got to do is just go to that one location. So scalable. And that was the one thing that I really liked about multifamily. And there's a ton of other things. I can go through all the other reasons why I love it. Tax benefits is huge. I think people underestimate how much that can help out. And then you got cash flow, you've got appreciation. I think multifamily has weathered COVID better than a lot of other asset classes, and we're seeing a ton of equity pour into it. What's going to happen there, right? You've got more demand. That's going to drive asset prices. Therefore, appreciation's going up. Therefore, you're going to make more money, right? Now people say, oh, well, it's going to be more competitive, right? Well, in a way it will be, but I think we're positioned fairly well to, to get some good off-market deals and just get some good deals in general. There's a lot of things that are going for multifamily that people need to understand. And a lot of it is the hierarchy of needs too, right? You got water, you got food, and you got shelter. And I think one thing that COVID has taught us is that for the most part, that's how people are going to live their lives, especially when there's something really, really bad that's happening like right now, right? Now, don't get me wrong. There are some people that just ultimately cannot afford the rent, right? And, we work with rental assistance programs, and obviously the government hopefully will continue to step in. But for the most part, if they have the money, they're going to pay the rent, and so that's not the same for, you got that office, right? And do I really need to have that office? Maybe I could just work from the house, right? And so it's not a mandatory thing that you need in your life, right? And even a retail store, right? Can I go online with this? Can I work out of my house, right? And so you really start saying, well, multifamily it's needed in this society. And that's one of the reasons that I really liked it too. It just made sense, right?
Yeah. You were talking about deals, right? So, do you feel like the market's overpriced right now? Do you think it's underpriced? Do you think has it been overpriced, or do you think what are your thoughts on the market right now?
It's the eye of the beholder, right? I've talked to some old timers, and they're used to the 10 cap days, and they think everything's overpriced. But guess what? They got out of the market 7 years ago, and if they would have just stayed in, they would have made a fortune. And so I don't think that cap rates can go to zero and asset prices can go to $1 million a door. But there's a balancing act, right? There's an equilibrium there, but it's all dependent on rents, right? And so really what I say, you have to look at the submarket that you're investing in, right? Is there job and population growth? If there is, what happens, right? If there's job growth, there's going to be development. From that development, you're going to have retail, you're going to have restaurants, you're going to have bars, you're going to have all these things, right, that are going to pop up, right? And I'm talking about Class C workforce housing, right? And take COVID out of it, right? Because this will all bounce back, for the most part. You're going to have jobs that are created from those white collar jobs, right? And that's where your tenants are going to work, right? So, more job growth drives demand for rental housing, and rental housing, if you have the demand go up, then your rents go up, right? And when rents go up, then asset prices go up, right? And you also have debt that's very, very cheap right now. And so you couple that with rent growth and cheap debt, and I'd say right now we're priced pretty well. Now there's certain parts of the country, right, where you're at, I probably wouldn't invest in DC and multifamily, but that's just my personal opinion. Doesn't mean that it's a bad market. I love DC, but and California is probably in the same bucket. But there's parts of the country that are doing very, very well, right? Rents are going up, population growth is there, jobs are going to those parts of the country, and that's going to drive demand for rental products, right? And I think single family home rentals are actually going to do pretty well too.
Yeah.
So one of the things that we're looking to do is build for rent, either doing townhomes or doing, duplexes or triplexes or quads down here, because I think across the board, people are going to be renting more and more. And so, something for your listeners to kind of look into as well.
Yeah. You brought up a good point there with, specific places to invest, because I always had this belief, like you invest where you live, you know.
Everybody does.
It wasn't until I met guys like you and other guys that were investing in the South, and I was like, what, Florida and Texas and in Georgia, and I'm like, why are you investing there? Why are you investing there? And then it was like, well, you get way better cash flow. Like, you know, in the Northeast, you know, appreciation is and values are highly inflated, right? So the cash flow isn't there, and it was that was amazing to me to start to see like the reasoning behind why all this money was flowing towards the South, and like the savvy investors were moving there.
And you get, and the other thing too is we got a lot of more space down here, guys. That's the one thing that I always tell people, right? And you've been down here. I mean, you know, Texas is a big state. We've got a lot of land, right? So there's these monster properties, right? You know, I mean, you talk about a 300 unit down here versus a 300 unit in DC. 300 unit in DC, that is Wall Street. No retail mom and pop investor can take something on like that, right? But here in Texas, you can buy a 300 unit property, right? Because the price per unit is reasonable enough that you can make a return on that, right? But it was funny, I met with a guy from New York, and, you know, he has investors trying to get money out of Manhattan. And he's like, look, they haven't even ever seen cash flow in Manhattan, all right? You know, so if you're providing 6, 7, 8% preferred return, you know, they're going to be ecstatic, because all they're used to doing is they sit on it. Sometimes it's negative cash flow, so they're putting money into it every month, and they just wait for it to appreciate, and then they sell it, right? Yep. That's their understanding of how investing works, right? Whereas there are certain parts of the country that you can have both. And don't get me wrong, it's not a slam dunk. These deals sometimes can be a challenge, right? From whether it be, you know, the tenants are, you know, you have to kind of churn the tenant base, which means you have to, you know, get maybe the bad tenants out and get good tenants in that are going to pay higher rent. You got to go through a rehab, which sometimes can take 12, 18, 24 months, as Oliver knows, right? He's helping us on one right now. This stuff is not an overnight, you know, revitalization of the property, but when you get it stabilized, the assumption is that it's going to cash flow at that point, right? You know, and then on top of that, you continue to push rents, therefore you're pushing your profitability, therefore the asset prices is going higher. Because what I love about commercial real estate, which was not in single family, is that you can pretty much chart your own fate, right? To an extent, right? If I make this deal more profitable, therefore it's going to be worth more, right? Versus my single family rental, doesn't matter if I completely upgrade it to the 9s, I might get a little bit of a premium, but the market is going to cap me out pretty quick, right? Because it's based on comps, right? Whereas, you know, on commercial real estate, it's based on a cap rate and it's based on your profitability, the NOI, the net operating income. And that was another reason I didn't bring that up. That was one of the reasons that I really liked commercial real estate, because now I can, you know, I can chart my own path. You know, I'm not, the market isn't going to dictate how successful I'm going to be.
Yeah. Yeah. And it kind of just walk that back a little bit. So you got NOI, which is your net operating income, which is going to be, you have your top line, which is your income revenue. And then you subtract out all your expenses and then whatever's left over. So if you're increasing rents and your expenses stay the same, right, you're going to have more income. You're now going to get paid a multiple on that income you generate. So the more income you have, the higher the sales price that is going to be.
Yeah, absolutely. Right. You know, and I'll go back to my first deal, right? You know, we increased the NOI on that deal by $200,000. You know, in the meantime, cap rates decreased by 200 basis points. So that was why I was so successful on that deal, right? You know, and so, well, and also we updated it pretty well. So bottom line, I got a premium for that deal, but that's the power of it. And people can do a calculation, right? You can say, okay, if I increase this property's NOI from $1 million to $1.5 million, and you keep the same cap rate, right? Say it's a 6 cap, right? Which is, it's between 5 and 6 for the most part, for everybody's knowledge. You know, that's usually where you're going to buy deals, is 5 to 6 caps right now. C and B, A's are probably more 4 to 5. You know, you can see how much value you've increased that property by, right? And I don't know the calculation. People are smarter than me, they can probably figure it out, but that's what it is. It's that easy. You make it more profitable, you apply a cap rate to it. That's how much you've increased the value of your property.
Yeah.
And
I love that.
You know, it's great.
Yeah. So you did bring up your first deal, and I know a little bit about it, but I wanna have you walk through a little bit about it and like how you protect your investors in the event of like a flood or a fire or windstorm. How do you go about protecting investors in those
You know, and I always tell everybody there's risk, and with anything that you can get a reward on, there's risk, right? And so, I take my fiduciary commitment to my investors. That's what keeps me up at night, right? Is making sure that everybody's money is safe and it's protected, right? Because I've talked to several wealthy, very, very wealthy people, like billionaire wealthy, and they're all about wealth preservation. They said, "Kid, I don't even want to talk about return on my investment until you can talk to me about the return of my investment," right? They would love to make money. Don't get me wrong, but they've already made money. They just don't want to lose money, right? So what do we do as syndicators, as operators, as people that put these deals together? We're trying to mitigate risk, right? So how do we mitigate risk, right? We do that several different ways, right? We buy right, which is probably one of the biggest things that you can do. You buy the right deal in the right submarket that has job and population growth. That's probably the best way to mitigate risk, right? Then you have a good plan. You're well capitalized, right? If you have a rehab, you need to have enough money to do the rehab. If you know it's going to take 12 to 24 months to turn that property around, make sure you have enough working capital, right? You need to be well capitalized. So buy right, in the right area, well capitalized. Now, you need to have the right debt, right? And people are like, "Oh, bridge is risky and this and that." And I say bridge versus permanent Fannie and Freddie financing on these properties, they're a tool. You have to have the right tool for the right problem, right? And so each deal is going to be unique, and you need to work with a trusted mortgage broker or trusted lender and work through the scenarios, right? What is the best debt that I should put on this property to execute my business plan and provide the returns that I'm projecting to my investors, right? So debt's another one. And you also have to be properly insured,
Yeah.
right? Insurance is
Just for a quick timeout. We'll get to the insured, but I just want to make sure everybody understands. So when Ben says bridge debt, that's basically a hard money loan in the commercial real estate.
it's there's tranches, right? Yeah, you got permanent like financing, right? And then you've got bridge, then you got hard money, right? So I would say it's kind of in the middle,
Yeah.
but there's you're time boxed. And so I think that's the risk part there, right? Is that, bridge is meant to be a bridge until you either sell or refinance into permanent financing. And so for the most part, it's 1 to 3 years. Sometimes you'll get an extension, sometimes you won't. There's some exit tests and some other things that you have to kind of go through. So you're time boxed, and therein lies the risk of it, right? And it's so in that case, it's kind of like a hard money loan, but hard money loans are usually 6 to 12 months. You can usually get these up to 3 to 5 years too, if you want.
Yeah.
So that's what I mean by when I say bridge.
Yeah.
Um,
So let's dig into the insurance.
Yeah. So insurance, right? You have to be properly insured, right? I think, for the most part, your lender is going to dictate a lot of, how much insurance you're supposed to have, how much loss of rents you need to have, but you need to understand how insurance works. It's kind of like a black box. We now own an insurance company, so I know a lot more about it, but back then I didn't. And so luckily through the Sumrock Group, I met a gentleman named Dan Kaderka. He owns a company called Strategic Insurance Group, and he's like a savant with this stuff. And so he sat me down for 4 hours. We're talking insurance. I mean, I kind of felt at the time like I was watching paint dry, but he was schooling me on the importance of it, right? Because what ends up happening in a lot of these Class C and B properties, right, is there's usually a claim, right? And so if there's a claim and you're underinsured or your deductible is too high, and I'll give you an example of that here in a minute, you're going to get screwed, right? And that's why, Marketplace Square, which is a deal that me and Oliver are partnered on amongst a couple others, right? There's parts of the property that had burned down. They were never rebuilt. Why weren't they rebuilt? It's because they didn't have the proper insurance to actually rebuild the actual structure itself, right? Or they took the money and they pocketed it, which might have actually probably been what happened. But some people just don't have enough money to actually rebuild the property, so they just leave it like that and they bulldoze it and they keep a foundation there, right? So if you don't have the right insurance on there, you can get screwed. And the right insurance is having the proper deductibles, right? Because if you have a deductible that's $1 million on a claim, guess what? Most claims are way less than $1 million. So you're going to be coming out of pocket for absolutely every claim that you have, right? Unless you have some tornado that takes out half the property, you're never going to have a claim that's more than $1 million, right? And so you need to understand what your deductibles are and be properly insured. On my first deal, so tie this all back, my first deal was in Beaumont. Beaumont's along the coast. What happens here in Texas, folks?
You get a lot of rain. You get a lot.
Well, rain is one. We have hurricanes, that can be very, very devastating. And so Hurricane Harvey came along, which was the one that really whacked us down here. Probably saw it on the news. Half the city had flooded. Well, guess what? Beaumont's only 90 miles east of us, and half of Beaumont had flooded too, right? They just didn't get the national news. And so my property was one of the ones that had flooded. And so it was a 92 unit property and 33 units flooded. And so we had to, terminate those leases, ask those people to leave because we had to remediate and demo those units. And what saved us was that Dan talked us into having flood insurance because we were along the coast. Now everybody would say, well, why wouldn't you just have flood insurance? You're along the coast. Guess what, everybody? Not everybody along the coast needs to have flood insurance, right? Because we're not all in a flood zone. And so just think about it. Would you buy insurance for something that you might not necessarily need, especially if it's a little bit on the expensive side? Maybe, maybe not. He talked me into it. The reason that I got talked into it is because this deal had so much meat on it anyway. $8,000 for flood insurance a year seemed pretty reasonable, right? And I'm glad that he did, because I got slammed with a flood insurance claim that was upwards of $2 million. So on that $8,000 flood insurance policy, FEMA paid out $2 million to help me get my property back and up to speed. And ultimately, I mean, it was way more money than we probably even needed, but we updated it from a Class C to a B, and I was able to flip out of it pretty quick. But that's the power of insurance. And if you don't have the right stuff on there, you can get screwed. Because I would say if I didn't have that, I probably wouldn't be talking to you guys right now. Because what ends up happening, right? You either come out of pocket as the sponsor of the deal, you go back to your investors, or you ultimately probably lose the property to the bank, because you're screwed.
Yeah.
It's a death spiral for your property.
Yeah. You used the term in there, loss of rents. Can you walk through what that is for insurance?
So insurance, for the most part, your lender is going to require that if you have a major claim, that you have loss of rent insurance. Now, that business interruption insurance is another way that they describe it as well. And it's essentially if you have a big claim, say you have a fire, 20 units just get gutted through a fire, right? Hopefully nobody gets hurt. Those 20 units are offline for the next 6 months. And if you're charging $1,000 times 20 units, that's $20,000 a month that you're losing, right? Your lender doesn't want you to be in jeopardy of not being able to cover your note. That's really all they care about. And you times that by, it's 20,000 times 6, that's $120,000. So that they want you to be able to go back to your insurance company, and they make it very, very painful to claim for loss of insurance. So just want to I want to disclose that. You go back to your your insurance company, and you say, okay, these 20 units are offline. They've been offline for 6 months. I'm going to claim loss of insurance, loss of rents on this. And they hopefully will reimburse you for that $120K. That's what that is. And it's usually pretty much mandated. I haven't seen a lot of deals where they haven't required it. And for Fannie and Freddie, they absolutely will. That's just part of their mandated insurance requirements.
That's great.
That's what that means.
That's great. And then you said the deductibles, right? So if you don't want to have $1 million deductible, because most things that are going to happen at the property are going to be less than $1 million.
Yep.
But like if you're buying a $15 million property, what type of deductible do you want to have on a property like that?
That's a hard question. I think it depends on the deal. Right now, why would somebody have $1 million deductible versus say a $50,000 deductible, right? A lot of slimy insurance people, and if there's any insurance guys, I'm one too now. So I feel I'm not trying to make, fun of anybody or be mean here, but they're trying to get the premium down, right? So if you jack up your deductible, you're going to pay less for the premium. Right. Whereas, okay, if you have a $50,000 deductible, right? Which the insurance company is going to say, well, you might have a claim that's going to be more than 50,000. So we're going to increase your premium a little bit, right? So there's a balancing act. Most people look at insurance as, oh, this guy is more expensive than this guy, so I'm going to go with the cheaper guy. But in a lot of ways they shouldn't, right? Because you're most likely going to have a claim at some point, and you need to have that right deductible, because that 50,000 is a lot easier to come up with than $1 million. And if your claim's 300 and your deductible's 50, guess what? Now you're not having to pay that other, 250K, which is pretty good. And so that's kind of the importance of that. And there's a lot of other things that insurance companies will be real slimy about, where they won't include, like, I'll tell you one, because we were talking about this the other week. In Atlanta, for some reason, a lot of insurance companies won't include barbecue pit fires. Right. And you've probably seen on our properties, right, that some people, even though we get onto them, we find them, we tell them not to do it, everybody's always got a barbecue pit. Right. And they did that because in Atlanta, for some reason, it's not as big a deal in Texas. I guess they had a lot of barbecue pit fires. And so now they try to exclude that. So if there's a fire because of a barbecue pit, they won't pay you. And so you're screwed. So you also need to read the fine print and see what is included in your insurance policy too. So those are some things that, I've asked me how I know. I've learned a lot of this stuff the hard way. Yeah. And that's the reason why I tell people the things that I do, because I want them to do the business the right way.
Right. Now let's just take a scenario, like a worst case scenario in a multifamily deal. Everything that could go wrong does go wrong. What's like the occupancy, the minimum occupancy, a typical deal that you have would need to hit to just keep moving forward, Yeah.
Are you talking about like break even?
Yeah, exactly. Because I always found this part like really fascinating, because like, you have this thing that's like, that's why you get into the business, because it has multiple sources of income. You got multiple people paying you rent, right?
Yeah.
So like it's almost like this insulator. I just kind of want to understand from you, what's the minimum occupancy typically you'd see at a property that could keep?
Typically it's going to be 60 to 70, maybe up to 75%, and then you start squeaking after that, right? And so if you dip below that, maybe not, you might start having problems. Right now, it doesn't mean that you're necessarily going to have problems paying your note. I'm talking about paying everything on the property, expenses plus your note.
Yeah.
Right. Because what a lot of people will do is they'll have enough rents coming in that they can cover their note, right, which will cover your taxes and your insurance as well. But then they don't have enough money to pay their vendors, or maybe salaries start getting tight, or some of the other expenses that you have on these properties. And so, if you're just talking about, hey, I'm just bare minimum, I'm just going to cover my note, right? You're probably talking 50 or 60s, in occupancy. Yeah. To cover everything, you're probably 60s to into 75 is probably where you're at.
Yeah.
Because you want to have enough meat on that bone, right? If you're doing a heavy rehab play, you might get down to that. Yeah. Pretty quickly sometimes.
Yeah. So if you look at that from a numbers perspective, right? You have 100 units. You're saying like you'd have to lose 25 tenants basically, or 25 people living in your apartments to be at a point where you're breaking even from income coming in and being able to pay the mortgage, being able to pay all the expenses on the property. Yep. Yep. So I mean, like you'd have to be doing something seriously wrong at that property really to have that happen.
Well, but I want to also caveat this, right? So people get jammed up on physical occupancy versus economic occupancy, right? So we can be 95% occupied, right, but if only 50% of the tenants are paying rent, then it's just as bad, right? Because those units might as well just be, vacant.
Right.
So there is a discrepancy between the two, right? I mean, you want in a perfect world, you'd be 95% occupied and 100% of your tenants are paying their rent. Right. Right. Unfortunately, especially this year, what we found out, the delinquency was never a problem, right? And I'll get into what is delinquency here in a minute. COVID has showed us that now delinquency is a big freaking problem. And for everybody that doesn't know what delinquency is, it's that people just aren't paying rent. They're delinquent in their rental payments. And it's something that was usually 1% to 3%, that you would just bake into your underwriting. And now it's 10, 15, 20% in some cases. And so, people need to realize, especially during COVID, until there's some kind of additional stimulus, until we fully open, vaccine is fully rolled out, right? You're going to have people that are going to struggle a little bit. And so you need to bake that into your underwriting as well.
Yeah. Well, you brought up a good point. So with collections, right? So you can have physical occupancy, which through COVID, we've seen people like, hey, I need housing, so like physical occupancy has definitely gone up. I mean, it's at higher levels than I've
Yeah.
seen.
It's mid upper 90s pretty
Yeah.
much across the board.
Yeah.
You
So
know,
from a physical standpoint, that's great. But then you said economic vacancy, meaning like people are in there and they're not paying rent. So you could potentially see some compression in like, hey, we're just being able to pay our bills. There's no money left over for like distributions, right?
Yeah. I'll give a real easy example, right? You have 100% occupied.
Yeah.
You have 100 units and it's 100% occupied. But if 50 of those tenants aren't paying you rent, then you only have 50% of your income that's coming in. So it's kind of a misconception, right? When we kind of say, oh, we're 95% occupied or whatever. But like I said, if some of those people aren't paying rent, then it's just as bad as those units being vacant. So people need to really understand that. And that really wasn't an issue until this year. Like I said, you'd bake it in, but it would be 1% to 3% tops, right? And so, because I'm going to tell people why wasn't it more than that? Because you had an eviction process. If people aren't paying rent, guess what? I live in and we invest in landlord-friendly states. I'm able to evict them. There is a process in place. That process has been taken away from the landlord lately. And so what ends up happening is those people understand that. They ain't paying rent if they don't got the money. And we have no stick, to get them out. So all we can do is negotiate, haggle, try to put them onto rental assistance programs, try to help them help themselves. And in a lot of cases, we've been successful. And in some cases, people just tell us to pound sand. They won't even open up the door.
Yeah.
So, people need to understand that is a unique issue that COVID has brought to the industry.
Got it. I love it. So we know you currently have 1,500 units now. You briefly touched on it in the very beginning, but where are you headed next? Like, what are you looking to do next?
I'm going to buy 2,000 units in 2021. And I say that so confidently because I have the team to do it. We have the capital behind us. We have the deal flow to do it. And I know what I'm looking for, and we're going to make it happen. That was a goal that we were supposed to do in 2020. Of course, things change. But now I feel even more confident because I have, I'd say I have even more of a robust team to do it. And so, because it's not the Ben and Fair show. It's certainly not me just doing this. I have a whole team behind me, from analysts to asset managers to property management, and they're all helping us execute our business plan. And that's taken a couple years for us to put that in place because you have to have enough revenue coming in to do that unless you just want to finance the whole thing yourself.
Yeah.
Right. Because one thing that I want people to walk away from is there's a lot of guys and gals that are probably saying, well, I just want to buy my own thing. I just want to do my own thing. And you can do that to an extent, even if you got $100 million in the bank. But what you're going to run out of is time. Right. You always need a team to help you, or you're going to work all the time. Right. And maybe you want to work. Maybe you're like me, and like, I love what I do. Right. But, I also kind of give the example of the doctor. Doctor works 80 hours a week. Doctor's making pretty good money, right? And doctor thinks that he just wants to buy his own deal. I think that's a really bad idea because what you are buying, folks, is you're buying a business when you're buying multifamily. And you're injecting capital into the business to make it better, but you're managing employees, you're managing payroll, you're managing all the expenses, including your lender, including if you have partners or maybe if you have investors, if you're syndicating. That is a full-time job. And so if you're working 80 hours a week already, Mr. Doctor, you're not going to have another 40 hours to dedicate to your multifamily property. And so why do I say all that? That means that you need to have team. You need to have partners. You need to have the right people to help you execute on that business plan, or it will go sideways so quick you won't even know what happened. Because 2 weeks in this business or let alone 2 months can torpedo a deal. And so you need to be on it weekly. And that is what I live and breathe. Where I'm on the asset management side of our business. I'm also on the equity raise side. So I live and breathe this stuff every day, and you need to be able to do that.
Yeah. Ben, there were some questions that came in on the chat. one of the questions was, is it and Garth asked this, is it legal that goes through the insurance doc to make sure everything is accounted for?
Is it legal?
Yeah. Who goes through that insurance doc to make sure?
The lender will definitely have to sign off on it, right? They dictate a lot of it, but you as the owner, as the investor, you should understand that. And if you can't get your insurance guy or gal on the phone to explain it to you in layman's terms, because like I said, this is complicated. The insurance companies make it overly complicated because they don't really want you to understand what you're signing. You need to know what you're signing off on, and so get your insurance guy or gal on the phone and say, walk me through this thing. And then say, now, is this in compliance with what our lender is wanting? Right. And the lender will push back. They won't even let you close unless you have the right insurance in place.
Right. Okay. Yep. Good stuff. There's another question that came in and said, while this insurance wake up is great, as an LP, you may only see an insurance line item on the pro forma. Is there typically a side conversation with the LP, or should the LP be asking for docs or something like that?
Unless you just like reading insurance documents, right? I mean, I think it's certainly, we always tell our LPs that you can ask me any question that you want, right? We're open and candid. You might not like my response, but I'm going to tell it to you, right? I don't know if that's going to be the decision if you should invest in a deal or not. I always say, because we're LPs, I'm passive in several deals. I have an IRA that I deploy money through. I ask 3 questions. I mean, I have three things, right? First and foremost, do I like the team? Right? Do I trust, like, and know the guys and gals that are doing the deal? Do I like the submarket? Right? Because the submarket, you can have a crappy deal in a great submarket, and the submarket will rise. All ships rise with the tide, right? And so that will help the deal out. And then, do I like the deal? Right? Because once again, these 2 things can make a crappy deal great, right? But if these 2 things suck, then they can make a good deal bad. And so, that's my litmus test when I'm looking to do an LP deal. Insurance is probably not on my radar as much, other than, is their insurance number realistic? I think in a lot of ways, some guys will underwrite deals very, very aggressively and maybe shave off, some expenses here or there that nobody's going to notice that, just to make the deal look a little bit better. The other thing that ends up happening in the insurance business is you will have some shady characters that will give you a crappy insurance quote up front. That's what you're going to use throughout your underwriting and selling it to your investors. And then you go to the lender, and the lender says, we're not going to accept this, or you need flood on yours. And especially this happens in Texas quite a bit. Oh, you need flood insurance now. And that blows up deals. Or the insurance goes from 100 to 150 overnight, and now the deal doesn't look as good. So insurance is important, but I wouldn't say that that's my deciding factor. Is kind of my point there.
Love it. And then we had another question coming from Leah. She says, where are these 2,000 units going to be? And same markets you're currently in, or new ones? Or
Texas, Georgia, and Florida is where we're investing. So those markets are awesome. Everybody's moving to these markets. Big corporations, Fortune 500 companies are already there or are looking to move there. And so, that's for everybody. If you're looking to buy deals, you're looking to invest deals, I would say those are, well, the Carolinas are nice too. And I like Phoenix. Those are the other markets that we like, but we're not going to focus on next year. We're going to focus on Texas first, Georgia second, Florida third.
And then David Mack asked, what parts of Texas, because it's a big state?
Primary markets. I'm no longer going to do kind of Beaumont type deals. I'm going to do Houston, DFW, Austin, San Antonio. In Georgia, I like Atlanta and Savannah. In Florida, I like Tampa, Orlando, and Jacksonville. I do not like Miami. Don't invest in Miami. It's a pie in the sky valuation, just like a Manhattan.
Okay. Now you said something there that I want to dig into. Why don't you want to invest in the smaller submarkets like a Beaumont?
I did very well in Beaumont. I want more diversification of the economy. Houston, and we had this discussion yesterday, Oliver, right? Houston's had a bad rap, but it's a BS rap. it's one of the most diversified economies that's out there, right? Oil and gas does not drive Houston. Yes. Now, is it a factor? Absolutely. But we've got all kinds of other industries, and so does DFW, and so does Austin, and so does San Antonio. Beaumont has a lot of great things going for it. It's got the port. Port is, I think, top 5 in the country. It's also got oil and gas and refining. But those are really the 2 things that drive Beaumont. Mm-hmm. So what I found out, which really scared me, was when oil went negative. I'd never seen anything like it. I was blown away. That was worse than seeing the stock market crash, because I've seen the stock market crash before. It scared the crap out of me, right? Because, you get to an inflection point where things really start creaking on oil and gas, right? And so when you're in a city that a lot of the drivers are driven by that, it's like investing in Midland, Odessa. And it's funny, Midland and Odessa, those are oil towns. And people are trying to always peddle those deals to me. And I'm like, absolutely not. I'm not having it. Whereas DFW, Houston, Austin, San Antonio have a lot of other things that are happening with it, right? Same thing goes with Atlanta. It's a diversified economy. And so if one economy, or if one part of that job sector slows down or goes away, the whole thing doesn't fall apart, right? And so that's why I'm trying to invest in primary markets versus secondary and tertiary markets.
Got it. Love it. We had another question that came in from Leah, and she asked, are you seeing an influx of people from California to any of these markets, or where are these people moving from?
Yes, we see more people coming from California to Texas, and I see more people from the New York area come to Atlanta. They're if they're not outright moving, they are definitely investing. And I think a lot of it has to do with just logistics. California's closer to Texas, New York's closer to Atlanta. Got it. That's pretty much, that's my thesis. I don't know if that's actually true or not.
Yeah. And we kind of hit on this a little bit in the beginning, but Maritime had a question. I heard so many comments about a potential crash in the upcoming years. Some people are saying it's a good time. Some are saying it's not a good time to buy rental properties. What do you think? And honestly, I love this question, because even like when we first met, you were telling me, like, people have been saying for years that it's at the top of the market.
They said that in 2015. I'm telling you, I literally had this conversation in 2015. I had met some old timers that have been in the business. They said, you're crazy. You're overpaying at 30 or 40 a door. I was buying this stuff at 15. And you know what? Hindsight's 20/20, right? So, you could say, oh, was I right or was I wrong? But at the end of the day, real estate, I'm going to answer this question differently. Real estate is hyper local, right? You're never going to have a crash that is going to affect 100% of the nation, right? And so that's why you have to really choose your submarkets well, and that's why I keep drilling into people. You need to have population and job growth. That drives demand and rental product, right? So we are in a recession right now. I don't care what anybody has to say about it. Yes, the stock market is doing great. I don't care about that. I'm talking about freaking jobs. People are out of work because of a forced pandemic. So I'd say right now you're in a recession, but I'd say right now is a good time to start looking at getting into investment properties, because debt is cheap, equity is there, and there's still good opportunities. People need housing, right? Once again, I go back to my thesis. People don't need office space. People don't need rental space. People don't even really need to travel. We found that out this year. Hotels are going to get crushed if they're not already getting crushed. But people need a place to live. Not everybody can afford a house. And so apartments are right there to fill that void. And that is why we get the best debt in across all commercial asset classes, is because our biggest partner in this is the federal government, because they subsidize the debt that is on these, because they want people to have affordable housing in these properties. So there's my tirade. So yes, I would say it is absolutely a good time to always invest. You just have to invest in the right area.
And I think your 3 things, what you said before, where do you like the team? Do you like the sub-market, meaning is there job growth, population growth? And then third, do you like the deal? And I mean, that's the frame you got to look at all of these things through.
Absolutely.
Yeah. I think
because, like I said, the team and the sub-market can make a crappy deal good, right? And vice versa, they can make a good deal bad. So people need to realize that, right? Versus the doom and gloom that we see, right? And I'd say it is pretty bad for some folks out there, right? But I don't know if I can't predict. Nobody has a crystal ball. Hell, I was January, February, we were launching a deal, right? Because we didn't think COVID was that big of a deal. Something was happening in China. So look what can happen in 3 months, let alone what's going to happen next year or in 2 years, right? That's why you got to buy right. I'd say that's one of the most important things on these deals.
Yeah. And then David asked, do you see long-term effects of COVID even when a vaccine comes out?
Yes. Yeah. The whole industries have changed already, right? You know, those screens that you see at the stores and all that stuff ain't going away. Those companies invested a ton of money in that. So the way that we shop, the way that we do business is going to change. I think business travel, you know, because in my IT gig, we sold a lot to the airlines and the airports, and I still have friends in that industry. They're getting crushed. You want to know why? Because the most profitable routes are business travelers and international travel. Guess what's not happening right now? Both. And guess what might not happen for quite some time? Both. Because Zoom like this that we're on is disrupting the whole industry of how you do business and how you conduct meetings, right? You no longer have to fly in to have that meeting anymore, right? And so I'd also say it's going to affect office, right? And how people, you know, have office space and utilize office space. And I think that in itself is going to shift how whole cities are laid out and mapped out. Because, you know, no longer are you necessarily going to have some kind of urban core where there's going to be a lot of skyscrapers, you know? And so, yeah, I would say it's absolutely going to have long-term effects, but with any challenge, there's always an opportunity too, right? Mm-hmm. And so you have to kind of look at how are the dynamics shifting and how could I potentially invest to, you know, to maximize or, you know, to leverage that or hit on that, right? And there's opportunities out there. I mean, just imagine if you're a mask, you know, if you're well capitalized and you could create a mask company, you know, you had the way to manufacture it, you would be making a killing right now, right? Whereas masks before, right, the only people that you had to sell those damn things to were healthcare workers, you know. I mean, so once again, if you're in the right place at the right time, you can make some money.
Yeah, yeah. Well, Ben, we're getting ready to wrap up here. I want to ask you one last question. What is the most important lesson you've learned in life?
Oh man, you're gonna put me on the spot, bro.
Yeah, we're making filter it through. This is
I would say, you know, scope out. I'm big on goals. I'm big on planning, but I think people have trouble where they get into this analysis paralysis is probably the best way that I describe it, right? Where they over plan. They put their goals down, but they think through them and all the risks that could, you know, well, what if this happens, or what if I'm successful and I just can't handle it, right? You know, I say go for it. At the end of the day, right? You know, you have to mitigate risk, which is what we talked about earlier in the call, right? But you're never going to be successful if you don't go out there and actually make stuff happen. Right. And I'm gonna give an example of making stuff happen, and it's gonna be for you, Oliver. You know, I had never gotten a call like I got from Oliver the first time we met, right? Guy cold calls me out of the blue. Never met Oliver in my whole entire life, and just starts pitching me on why we should partner with him, right? And I was so blown away. I had to look the guy up. I was like, what just happened? You know, nobody had ever approached me in that way, and not in an aggressive way. He was very polished on the phone, just kind of talking through what his goals were and how he could help. And, you know, was there a way that he could add some value so he could partner with me? I was so blown away. We ended up partnering on our next deal, you know, so I say go for it, right? And that was the one thing that I wasn't doing until 7 years ago. I was playing it safe for the most part. I was socking away money, hoping that, you know, I don't know, some other opportunity would come along. And I say, no, screw that. Go for it, deploy capital into risk-adjusted investments, right? And you know, live your life. Don't live it in fear, especially this year. Everybody's just scared. And I say there's opportunities still, and you should still get into the market and still try to make things happen.
Yeah. No, I love that, man. That was good. That's one of my big mottos is like you have an analyzer muscle, and everyone needs to work that analyzer muscle, but that analyzer muscle can never be bigger than your action muscle. Because
Yeah.
if it's bigger than your action muscle, you just sit there analyzing stuff, analysis paralysis all day long.
And I see it all the time. I can size somebody up in 2 seconds. Is this guy or gal ever going to do a deal? And sometimes you can just feel it. They're never going to do a deal, right? And it's because they come at you with their anxieties about the process. And what about this? What about that? There's all kinds of things that could potentially happen. And guess what? I mean, not everything that I've done has been a slam dunk success, right? We've certainly had our fair share of challenges, but I would continue to make that same thing and just go out and I continue to go out and make it happen versus just getting crippled by the whole process.
Yeah.
You know?
We did have another question that came in from Perry. He said, what are some advice or recommendations for analyzing the team?
Referrals, are they, I mean, talk to people that maybe have done business with them, right? I'd also say, what is their acumen? And I'm not saying that this is a big deal. This is not a deal killer, but, are they an entrepreneur? Have they run businesses before? Right. I mean, because ultimately, like I said earlier in the call, we're buying businesses. That is what we're doing. It just happens to be in the form of real estate. Right. So do they know how to run a business? Do they know how to run teams? Do they understand how financials work? Right. That's a good way to size them up. And that's just simple questions. Right. So get referrals first and foremost, and then have a conversation with them. Right. Do you get a good warm and fuzzy, right, talking to these people? Do they know what they're talking about? Right. And then try to get some of their track record, right? Some people are starting off and they're not going to have a big, long resume and 30 years in the business and 25 different exits and all this other stuff. But, that will allow you to size the team up. And once again, once you get a good feel for them, everything else starts kind of, okay, now I got a good feel for them. Now let's talk about the submarket, right? And have them sell you on it, right? That's the most important thing, right? Do they know the submarket that they're investing in? And then just validates, trust but verify, right? You always have to do your own research on these deals. You need to underwrite them yourself, and you need to ultimately be comfortable with what you're getting yourself into.
Yeah. And then I think too, with that, Perry, it's just about being consistent. I mean, it's like the people who are consistently there, those are the people who are going to consistently be there. I mean, just think, even in your own life, the things you consistently do are the things that you have confidence in. Those are the things that you can, that's how you find confidence, is through consistency.
Yeah.
So,
And people, that's what one point too, right? Are they out there in the public, right? I'll get out there warts and all, man. I mean, I'm not going to say that every single deal, has just been a home run and we don't have our own challenges, but I'm out there trying to provide, some content, some education to people and be out there in public, just kind of put myself out there. Whereas I see a lot of these guys will kind of just hide in the shadows. That just kind of seems shady to me. Right. And so you kind of also understand what are they doing in the market to make the space a better place too.
cool, man. That was awesome, Ben, man. You rocked it.
Thanks,
You're always looking to provide value for, actually, that's another cool thing. I'll just share that with you. So like most people are always looking for money. Like what you need to do is you need to step in front of the money and do the thing that's going to cause the money to come. And then that's adding value, and continue to add value. So don't think about what you want. You got to think about what are 2 or 3 things that you can do that happen before getting what you want. Yeah. And that's what, Ben, you've been doing like for forever since I've met you, is adding value. And look, you've just continued to grow and continue to do big things, man. And I love being around people who are big thinkers and not even just big thinkers, but big doers. So
appreciate that. So thank you.
Cool. Thank you, brother. Yes, we got everybody saying thank you. Leah's did a bunch of fires. Garth says this was a great.
Yeah.
Thank you, Ben, Oliver, and all. Yeah. Perry's like, thanks, Ben. Great, real info.
Thanks, guys. No, gals, I appreciate it. It's good chatting with you.
Yeah. Mark says, right. Thanks, Ben. You're the best. Ben is like saying, thanks for all your knowledge. Christian, thanks, Ben. Perry's, thanks again. All these guys, we're all happy, man. We're so grateful you were able to.
And I like talking about this stuff. So you guys ever want to drop me a line, it's ben@disruptequity.com. So, as you guys can tell, I like talking shop.
Yeah. I'm going to actually, can you put that in the chat, Ben, at Equities, if anybody wants to.
And I found this out recently because we've been doing a ton of these. So if you go to where you're going to do the comments and you click on those 3 bars, you can actually copy this chat box to your local drive too. I didn't know if anybody knew that. I've been telling everybody that because I thought that was the coolest thing since
Oh,
sliced bread.
save chat. Cool.
Yeah, you can save the chat.
Yeah.
So I didn't know that until like 3 weeks ago, and I've done like hundreds of these. So you know, I thought it was cool.
Yeah, no, that is good. All right, Ben, we appreciate you.
All right.
Thank you, brother. Have a great rest of your day, and have a great weekend.
All right, you guys too.
All right, cool.
Bye.
Yep, bye.
Hey there, I hope you enjoyed the video. If you did, please click subscribe down below and give me a thumbs up. You can reach out to me on Instagram or Facebook at Oliver Fernandez 3. I have new videos just like this one dropping every week. So drop a comment down below and let me know what you want to hear next. Until then, keep growing and keep learning. Just do it.